Hello everyone, this is Christian from Z Investor, and in this video we're going to be going over some of the worst investing mistakes that newer investors tend to make. First mistake we're going to be talking about is overexposing yourself to any singular position, whether it be a stock, asset, whatever. And those who understand why diversification is important will already see where this is going. This is because whenever you put more capital into any singular position, the greater effect it'll have on your total portfolio. If I decide to put 100% of all the money I'm investing into a singular stock like Google, if Google just happens to drop 10%, so will my entire portfolio. If you've ever heard the saying, don't put all your eggs in one basket, well, yeah, it's pretty much that. And it's important to do this because even some of the best investors can get a stock wrong. Sometimes they'll think that a stock is extraordinary. Well, in reality, they could be missing something. And it's important to factor that in with how much capital you put into any singular portfolio. No matter how much you like a stock, there's always a chance that things could just not go your way. However, this actually goes beyond just singular stocks. You should be careful about putting all of your capital into singular industries as well. Some glaring examples of this is maybe tech, retail. I've seen this firsthand. Some investors thinking they are diversified when they have all their stocks in Nvidia, Microsoft, Google, Facebook. And the reality is, well, they aren't really diversified. All of the stocks that I just mentioned are related to tech. And if the tech industry starts to slow down or just general business trends occur, well, that's not really diversified. Okay, the second mistake we're going to be covering is when investors hyper-focus on specific metrics or flashy numbers that are associated with any stock. And I'll give you a fantastic example of this. The PE ratio is just a ratio, a number, that describes the relationship between the price of a total company and how much they earn in a given year. Okay, so just off of that, you can assume that you want to aim for the companies that have a lower price to earnings ratio. After all, it's a better bang for your buck. If that were the case, why would anybody buy tech stocks like Microsoft, Google, when they're all trading at PEs of 20 to 25, somewhere around that? I mean, surely you could find way better stocks, trading at 5, 3, 2, 1 PE. So why would they still buy these tech stocks? Well, the answer is simple. It's because PE is not telling of the company at all, pretty much. Instead, you should be focusing on financial statements. Learn about the company in general. Learn about its moats, competitive advantages in the industry, and so much more. You shouldn't be attached to a singular metric. But you see, hyper-focusing on random numbers doesn't end just here. In fact, I've seen a lot of investors get caught up with those analyst ratings and seeing a price and automatically judging an investment based off of that. I think we can all relate to this scenario. You find some sort of flashy stock and you think, wow, this could be a great investing opportunity. So you do some more digging and this leads you to their Yahoo Finance page. You scroll down and you see those numbers. This analyst is giving this a buy rating at $15, let's just say. And oftentimes you'll see these predictions at 4 or 5 times the company's current price. Well, you just found an amazing investment, right? Surely these numbers must mean something. And if you're thinking, well, okay, I need to do at least some more research than just some price predictions. Well, some people don't. And this is why it's important, and I'm telling you guys to actually look at the reasons behind these predictions. A lot of the times, some of these arbitrary numbers these analysts seem to come up with is just pure garbage. But it can actually be helpful to take a look at those predictions and see what kind of reasons are behind them. It's a great way to see how an institution will look at a stock and also give you a quick highlight of some of the positives and negatives of that company. Okay, the final mistake we're going to talk about is going into options way too early before they completely understand how they work and all the intricacies that come along with them. Remember guys, options are leveraged and they also expire after a certain date. And this is very, very harmful. Think of any given stock. If you buy it and let's say in the short term, it just doesn't happen to go your way, there's a little bit of a drop. Well, that doesn't really hurt you at all because you can continue holding if you believe that the long-term story is still intact. With options, they have a certain date attached to them, meaning you not only have to guess which direction the stock will head, by how much, and by a certain date. That isn't exactly odds that are in your favor. And in addition to exposing yourself to 100% losses as a downside, there's also many ways that newer investors get crushed with IV and illiquidity, just to name a couple. Anyways, I hope you guys enjoyed this video. Let me know in a comment if there's any other mistake we should add in the future. We'll also have more guides coming out on beginner investing stuff. Anyways, see you guys later.